Okay, so good morning to you. Before I get going, there's a few folks I need to recognize. So we are all shareholders in this room, but I must confess there's one shareholder here that has a little extra influence over what happens at BuildGroup, and that is my beautiful bride, Dacia, of 25 years. She's here in the back. So Dacia, there you go. Woohoo! All right, so what I would tell you, if you want to change in strategy at BuildGroup, I would, there's your path. Okay, there's your path. All right, we've also got some of our board members here. And what I love about our board is that our board is actually the biggest shareholders in our company. Look, so BuildGroup's a company, we're building this company for you to create long-term after-tax wealth. All right, and our board members all stepped up and made significant investments in the company and are amazing coaches and advisors for us. All right, so Brian King's right here. So Brian's here. Bud Scruggs is here. I saw Bud earlier. Okay, Miguel. Yeah. Don't worry. Yeah, Bud's up for you're the late night, right? Bud's a late night show. Okay, so Bud came in from Salt Lake. Brian from DFW. We've got Miguel Fernandez, right? Muy interesante. He came in from El Paso. And Randall Mays was here yesterday, but he had to depart last night, so he's not here. He's not here for this meeting. So if you think about our journey here together at BuildGroup, we're all shareholders. I mean, if you look at the senior executives at BuildGroup, BuildGroup's my largest personal investment. It's the largest investment for all of our senior members. So unlike lots of other shareholder meetings, I would just say this group is completely aligned. We are focused on the right, long-term after-tax wealth things. We've all got a lot of skin in the game. And if you go back, it was just 18 months ago that we actually closed our funding. Okay, so it's only been a little while since we closed our capitalization. I would tell you, I think we're off to a really cool start. And what we're going to share with you today is I'm going to do my best to make it a really simple strategy. Now, look, I'm kind of a nerdy guy. We're going to have a little bit of buzzword bingo, okay, because I like all these cool technical words because it's like saying it makes me happy. All right, but I'm going to try to keep that super simple for you. And I'll get through this material. By the end of the material, I sure hope you have a real good feel for our investment strategy and how we've advanced on that since closing. A good feel for how we implement that strategy, all right, and what we're looking for in the world, okay? I'll get through this at a decent clip. Then after that, any question you have, any Scud missile you want to launch my way, launch it. If we run out of time in this thing, I'm here all day, probably all night, okay, so you can launch your Scud missile at that moment as well. All right, so now I start with the Kenny slide. Voila. Okay, I'm not sure what that says, but it's very important. That's why it's in such small font. All right. Okay, so here's the agenda for today. All right, so I'll get into the strategy, why we're around, how we do it, what we're up to, etc. So when you think about what we have at BuildGroup, this is what we got. All right. It starts with an investment team. Tanner, he highlighted and introduced members of that team already. Look, that investment team spends their time sourcing investment opportunities, assessing investment opportunities, scoring investment opportunities, and then executing that transaction. All right, so we spend a lot of effort inside of BuildGroup doing that stuff. We also have an operations team. All right, that operations team, the reality is we all kind of do a little bit of it today, but this is where we implement our playbooks into these companies. So we have an investment strategy. Part of that strategy is implementing our operational background into these companies. We do that in the form of what we call modern business model playbooks. I'll give you more detail on that in a minute, but that's the second leg of our stool. And then the last leg, the data science team, which you'll get a big preview of this afternoon, is really it's where the real nerdy stuff shows up. Okay, so we are software investors. It turns out we've been building software to make software investments. This is a very data-driven exercise. All right, so we built software for ourselves that we'll show you later, and our data science team is going to become a bigger and bigger part of our company. So inside of BuildGroup today, like I would say every other investment shop, it is still 90+% human. Things are done in a manual fashion. Human beings are making decisions and coming up with judgments. Over the longer term, as we build this together with you for the next 20 years, we want code to take over more and more of it, all right? Because code's more scalable. It turns out code doesn't need a break. It doesn't get tired, all that kind of stuff. Okay, so first let's start with why we're here. It's pretty darn simple. Turns out we're an investment company and we're here to make money, all right? The way we think about money is we think about it on an after-tax long-term basis because it turns out all of us are taxpayers, right? This is one thing that's unusual about BuildGroup relative to other investment platforms is we are actually all taxable things. Now, there's one or two exceptions to that in our shareholder base, but 98% of our shareholder base, 90+% of the dollars inside of BuildGroup are taxable dollars. Okay, so what that means is when we enter an investment, we are thinking about long-term after-tax outcomes for people. So part of thinking about returns is I find this super interesting. Okay, so what this shows, my source data here is McKinsey & Company Markets Report. It's just setting forth for you what returns like over periods of time for VC funds versus PE funds. All right, and if you look at these numbers, they're remarkably similar. Now, yes, every year is a little different, okay? But if you look at sort of the aggregate output of these asset classes, it's remarkably similar. So call it in the teens. Now, sometimes, one might beat the other kind of thing. And who knows, over the next 5 years, maybe the asset classes separate a bit more. But it is just remarkably similar how those returns look. What's noteworthy about this is the methodologies are very different. So if you look at a private equity fund, for example, private equity funds typically invest in later stage companies. They apply financial leverage. They're trying to increase the growth a little bit. But it's more about traditionally it's about a cost reduction game and it's about a financial leverage game to make that IRR. Okay, when you look at a VC fund, okay, what VC funds do is they invest in a whole bunch of companies. Half of those companies, 60% of those companies turn into big old goose eggs. Another 20% return the money, and then they have a handful of companies that make all the cash. The early investors in Facebook, the early investor in LinkedIn or Salesforce or whatever. So basically, when you look at these two asset classes, PE takes much lower risk, but doesn't have the upside. VCs take much greater risk. 50 to 60% of their companies fail, right? But then they have this amazing upside in a handful of things. So, the market pundits talk about VC returns as a power law outcome. Meaning all their money gets made in a few investments, whereas PCs are a much more distributed, diversified base. So part of what we're trying to achieve here is how can we build companies in a way that have the risk of private equity and the upside of the power law outcomes in venture capital. All right, and so we think our investment thesis is going to deliver that. All right, so the first thing to note in this thesis is that software business models are changing. Okay, so what you have here is my little view of the world around what's going on with business models in the software industry. 20 years ago, on-premise software reigned supreme. 20 years ago in our businesses, we bought software, we ran it on servers inside of our companies. We had a legion of IT folks administering those servers, and this is how it worked. This is how it happened. Now, companies like Rackspace, all right, basically moved that stuff out of the company and into the cloud, right? And with that, there was a rise of SaaS software. So over the last 20 years, SaaS software now outstrips on-premise software. So there's our first buzzword, bingo, SaaS. Okay, so SaaS, all that means for is software as a service. It is software delivered over the internet to you. So instead of buying the software yourself and running it, you just pay a company like Salesforce or Microsoft Office, $50 a month, $100 a month, $100,000 a month. So over the last 20 years, SaaS has eclipsed on-premise. What I'm here to tell you today is that now the SaaS business model is changing. And it's now what we would call SaaS Plus. And because we're really cool branding people, we call SaaS Plus modern business models, all right? And the reason we call it modern business model is when we sit down with entrepreneurs, man, entrepreneurs love to dig into modern business models. When I pitched them SaaS Plus, they didn't love to dig into that concept as much. We got some of them in the front row over here, right? There's the VidMob crew. Modern business model is super cool. SaaS Plus is actually what it is. It's just not as cool to say it, okay? So we're sticking with modern business model. And the rise of modern business models, I would say, has happened over the last 6 or 7 years. And I think it will grow as a larger and larger piece of software delivered over the internet. So our investment strategy is pretty simple. And in a minute, I'll take you through the components of a modern business model and why I think it's super cool and compelling, okay? But our strategy is really simple. Number one, for SaaS Plus companies that have the elements in place of a modern business model, we want to invest in them and we want to help them grow faster. We just want to accelerate the value. Okay, for SaaS companies that don't have all the elements of a modern business model, all right, we want to invest in that company. We want to apply our playbooks. We want to come up with some more of the elements for the modern business model and see if we can activate the whole thing. Okay, so it's really simple. If you're a native SaaS Plus company, we're going to invest to help you grow faster. If you're a SaaS company without all the components, we're going to invest add some of those components, and then help you grow faster. Okay, and all that is done from our perspective, with a long-term orientation. I mean, we still live in a world where a lot of the capital markets are pretty darn short-term. And we see this in some of the companies we invest in, where other shareholders like, look, we've been in this thing, a couple years now. We've done really well, time to exit. Our orientation is still, look, we're a permanent capital vehicle. We're trying to compound for a long time. When we have a good company, man, we just want to keep going. Let's just keep the growth going and going and going. And that makes us really different in the marketplace. So let's break down, some of these components of a SaaS plus modern business model. The first thing to start with is the subscription base. Okay, so that subscription base it's no different than the subscription you pay to Netflix every month, right? If you've got kids, your teenagers are on Netflix all the time, you're paying Netflix X dollars a month. That's how software gets delivered. Okay, so you start with that subscription base. And for our world, the subscription base is all to businesses, right? We start with the B2B subscription base. We know the most about selling software to businesses, selling services to businesses. That's our heritage. Those are our roots. Okay, and then once you get that really going, when you can add the right type of data science to the company, which we'll get into, you can generate some network effects. All right, network effects are just reinforcing loops that help you grow faster by delivering a programmatic match or a marketplace to that community. So the way to think about it is, inside of a SaaS business, there's a subscription base of a bunch of customers. Inside those customers are a bunch of users. Those users are a captive community. What we want to do on top of our subscription base in these businesses is provide other offers to that captive community. So let's start going through the components. This is Sas revenue. So SaaS revenue today, if you look at software sold, it's about $75 billion a year. Okay, so that's a big nut. The market tends to value that at about 10x today. Okay, which is a really, really big nut. All right. If you look at SaaS went from 0 to $75 billion in sales as an industry, to call it that, in 18 to 20 years. Okay, it is now projected to only grow about 15% going forward. Now look, 15% is pretty good. If you're in the death care business, you're probably craving a 15% growth, although that's a bit morbid. But for SaaS, it's remarkably slower than it used to be. That's why I think these business models are changing. So if you look at the alterations these companies are doing, they're looking for additional ways to create value, and I think we've got a really good insight on it. So that's the SaaS part. When you look at the match and marketplace, what I tell you on that is historically, marketplaces were, you drive up to the flea market, right? In the old times, we'd go to the bazaar. That was an instance where people were searching for what they wanted. You'd walk through all the stalls. Okay, you'd look for that piece of furniture, that shirt, your new shoes, whatever it is. Okay, you're trying to find that thing. It's really a process of discovery. Okay, what I would tell you is happening now is once companies have a captive community, you can use data science to really put the exact right offer into a programmatic match in front of somebody where it's really not discovery. Okay, you see remnants of this today, artifacts of this today when you go into Netflix and it makes a recommendation for you on what to watch, right? I mean, and they're actually pretty darn good matches. I watch a lot of history stuff, so when I log into Netflix, I never knew there was so much stuff to read about watch about World War II or World War I or the Civil War or more Ken Burns documentaries, whatever it is. Okay, so I think what we're discovering in these places, when you're a business, you have amazing data about your customers, not only can you sell them a subscription, you can bring in other partners to add additional goods to them and drive up the revenue. Okay, so I capture all this in a triangle. Okay, now it turns out Alex over here, co-founder of VidMob, is coming up next, and his triangle is animated. All right, my triangle is not. Turns out VidMob is much more of a high-tech software kind of thing than I am. Okay, so my triangle, regular old triangle, and what I've captured for here is the following. On the lower left, for us, we got to start with this B2B SaaS business. At our core, we are SaaS investors. We are software folks. It's just it's what we've spent our life doing. Okay, so we start there. Once you get that really good, you've got to invest in a tech stack. The tech stack's in the center. The tech stack is what powers that software. The tech stack is what creates the ability to match other offers to this captive community. Okay, that captive community is the lower right. Okay, so now you've got that piece of it. On top is what I would call the strategy that these companies need to do. One part of that strategy is to drive that SaaS business deeper and deeper and deeper into that customer set. It's got to come up with more offers. It's got to get deeper into the mission-critical workflow of that company so it is super sticky, right? And once that thing is super sticky and you capture a ton of data, you can start to bring in partners to do other matches for you. And I'll take you through a couple of modern business model examples, these SaaS plus companies that you all know that are totally killing it. They're just the first ones through the chute. Okay, so the first one to talk about here is Amazon. All right, so Amazon, look, you all know it. You get a legion of brown boxes to your houses. You know, if you go to 701 Castano, San Antonio, Texas, 78209, we get, 3 prime boxes a day. I mean, everything's nutty, okay? So Amazon did it backwards from how we do it. All right, Amazon started with that B2C thing. But some little known facts about Amazon is that Amazon now has a $50 billion a year subscription business growing 40% a year. Okay, so if you think about how in the world has Amazon kept its market cap growing at the rate it's growing, how is it growing faster than all of its e-commerce peers? It's that subscription business. And when you really get these things going, they reinforce each other. Okay, so Amazon started out selling all of us a book, right? Then they went into video, then they went into pots and pans, and they went into all this stuff. But what they started doing about 10, 12 years ago was they started creating subscriptions. Their first subscription was a rack-based killer. It was called the Amazon Web Services. It was their cloud. They had incredible economies of scale and incredible demand economies as well. The next thing that they rolled out was this thing called Prime. Everybody in here is a Prime customer, right? And so what happens when you're a Prime customer is you pay Amazon a subscription, and then before you know it, you're paying Amazon a lot more stuff on the other side too. So these things reinforce each other. So what happens in a subscription business, when you start with B2B SaaS, and you have that captive community, Amazon got the captive community through B2C to us. Then they figured out how to do subscriptions later. And their subscriptions are now growing twice the rate of the rest of the company, which is why their market cap continues to crush it. I mean, it's an unbelievable story. So there's my first consumer example for you. But full disclosure, BuildGroup, look, we're consumers because we eat and buy things, but that's not really our game. Our game is B2B SaaS. So I want to tell you what I think the best B2B SaaS modern business model is. And it's Salesforce, okay? Little known trivia fact, my brother actually works at Salesforce now, okay? So I don't have any inside information, all right, but this is super cool. So Salesforce was one of the first SaaS companies in the marketplace. I mean, Salesforce was founded about the same time Rackspace was founded. So I've known Mark Benioff, the founder and CEO there, for a long time. Salesforce basically started selling you software to your business to help you manage your Salesforce, hence the brand Salesforce. All right, that software helped you put a sales rep's quota helped into the software, helped you manage their pipeline. I mean, how many of y'all are Salesforce customers, right? I mean, I'm surprised it's that few, because I think they are almost ubiquitous inside of B2B. As long as you have enough enterprise budget, they're the choice. If you don't have the budget, you end up with Pipedrive or something. Okay, but Salesforce pioneered this. Sorry, do y'all have Pipedrive? We do. Yeah, I'm a Pipedrive customer. Yeah, Salesforce too expensive, dude. This is why Mark Benioff has a hospital in San Francisco. All right, but anyway, so what we have is Salesforce started with this incredible piece of software for just Salesforce management. Charge you a subscription for it. And part of their beauty, which we should all note, is when we can sell software to functions that drive revenue in a company, you can kind of sell them more and more software forever. Right? We've all wanted to be on the revenue side of life instead of the cost side of life. When we're a company selling on the cost side, it kind of sucks. Right? When you're a company selling on the revenue side, it's like unlimited budget. Because people can dream big dreams. So with Salesforce, they started with that B2B Salesforce management subscription. Over time, they added additional capability into that. They did acquisitions to go from your Salesforce into your social media profile, from your social media profile into publishing, from publishing into ads. So they started to get deeper and deeper in that. And then they did something really clever. They determined that within those businesses, there were millions of users. So they said, you know what? We're going to create an app exchange and allow those users of our software to buy software from other people that makes our software better. Okay, so this is when they started their B2C part. The B2C here is the business to community. They figured out if they opened up their network, if they opened up their customer base to those users, other software companies would pay Salesforce money to sell software to Salesforce's customers. And in doing so, Salesforce's core software got better. The experience was better, because now once you're part of that community, you can do more things. Salesforce had a good strategy for curating these things to make sure they'd integrate, to make sure they would function, and it worked. So Salesforce was the first SaaS company of scale, in my mind, to take on this strategy. Now, there are others behind them, It turns out most of the small SaaS companies in the world don't think of it this way and aren't doing it. That's why I think our investment strategy has real merit on it. So Salesforce today is about a $13 billion company in sales. Now look, their market cap is kind of nutty. All right, they're at 160 billion. All right, so what I would tell you, I do think markets are frothy. Okay, we should all be disciplined. I would not count on that kind of revenue multiple in this sector for the next 10 years. I think that's probabilistically highly unlikely. But I do think what Salesforce has done is pioneer a path and a way that really works inside of these business communities. So now I want to take you through our portfolio, the companies that we think have a lot of these SaaS plus elements, right? They have them in place. We're working on them. The CEOs are here. There may be one or two who's still arriving, okay, but they're going to be here over lunch. As you get a preview of these companies, to the extent you want to have lunch with the CEO, they're going to be at different tables, okay? So, figure out which one you want to meet with. Okay, you can also have lunch with builders later this afternoon, in the same time. But let's get into some of these companies and go through the progress reports. Okay, so we're going to stick with the triangle, right? So one thing I want you to be able to do once you leave today is draw a triangle. Right now, you may not get all the nodes right, but we're going to have triangles, okay? Now, on the lower left, right, you have the B2B SaaS. Then we're going to talk about the community, and we're going to talk about the new offers and stuff. So this company's Anaconda. Co-founder and CEO in the back, Peter Wang. So Peter, there you go. All right, perfect. So Peter's a physicist, right? Cornell trained. He's a big brain. He can tell you all about Star Trek and stuff, as well as data science. Sorry, Peter. Okay, so let's talk about the core value prop of Anaconda. If you are a data scientist today and you get going for data science, there's a core problem around. There's so many different software packages out there. How do you find a place to get necessary ones to start rolling? All right, so imagine a library without a Dewey Decimal System. That's what it's like when you start as a data scientist. Okay, so what Anaconda's original offer is they provide open source software, which means it's free, so that when you commence being a data scientist, so I have Anaconda on my laptop, you get a free account with Anaconda, and within that account, really quickly, you get a core set of software packages. Now look, those software packages may change over time, et cetera. There's some limitations, but man, you get rolling in a hurry. Okay, and this is why Anaconda has that community base of over 15 million people. So what I would tell you, there are certain types of knowledge workers that are really valuable. Some knowledge workers are more valuable than others. I would say a community of 15 million data scientists on today's planet is super valuable. Any given month, 3, 4, or 5 million of those data scientists are using Anaconda. So when you walk into tech companies in Austin or Silicon Valley or whatever, and you say Anaconda, all the nerds in the room know what you're talking about. Right? So Anaconda started there. Then it rolled out an enterprise level offering, okay, that's now selling $18, $19 million a year on a subscription basis to, I would say, Fortune 500 companies. It's the Exxons of the world, the Goldman Sachs of the world, some of our intelligence agencies, and that's about 19 million bucks a year. So the strategy for Anaconda going forward is we're going to deepen that subscription offering with those customers. Okay, one thing we're going to do is we started out with a product there of about 200,000 bucks a year. We need to walk that down to a lighter weight product. That rolls in February. Okay, and then we need to go from a freemium offering on those consumers on the right side to start getting them $50, $100, $200 products as well. Right, so this is a big one. This one has a huge opportunity in it. It's a massive embedded network. It's got blue chip customers today at the enterprise level. We need to accelerate the growth in it, so that's what Peter could talk about over lunch with you. But it's a great example of an embedded SaaS plus company. Okay, it's got all the elements to where we ought to be able to build a category leader here. The next one's VidMob. Now, since Alex is going to be up here literally right after me, I won't spend a lot of time on VidMob. VidMob's 13 million in revenue. All right, he'll take you through the business model. It's growing at a high rate. Its community is creatives. Okay, so the way I think about VidMob is they're basically an interface into the creative community. And so imagine a world where, for your company, when you're doing your video branding campaigns, you can literally tap an online creative community through your subscription base of hundreds of thousands of people and crank out content real quickly versus going to an agency and other stuff. And he'll take you through the technology they use to make that repeatable and scalable. All right, so I won't steal any more of your thunder. All right, and VidMob was an investment we made just a matter of months ago. Call it 6 months ago. All right, so it's early days. They're headquartered in New York. Okay, the next one is Cybrary. So this company does online cybersecurity training. So as you know, cybersecurity is a real risk. You know, everybody's getting hacked. Just for the record, there's lots of online scams going on where people are wiring money, you know, out of their companies and stuff. We've heard that a lot lately. Okay, so cybersecurity is a big risk. You know, Cybrary is at $9 million in subscription revenue. They grew 100% last year. They're based outside of Washington, D.C. And the way their business works is pretty simple. Is as a company, you know, you pay them a subscription for a library basically of cybersecurity training. Okay, so the substitute product is to take people out of work, send them off to a training class. You send 2 or 3, you pay $100,000, whatever it is. They're out of work for those 3 days. You know, and they come back and they're supposed to tell everybody about it. All right, what Cybrary does, it has a community on the right side, a captive community that generates all this content, you know, for the most part free. The company also generates some of the content, and then it sells it online as a subscription. So I would just forecast for you for the rest of our working lives, cybersecurity is a real problem. It turns out distributed infrastructure favors lots of bad connections. Okay, so this company has a really interesting value proposition around how to do this in a scalable manner. All right, so I don't know if Ryan's here yet. Yeah, where's Ryan? Okay, there's Ryan in the back. Okay, you know, founder and CEO. All right, so we're super pumped to be partners with you on this, and it's only been a few months, but high expectations. Okay, all right, so that's Cybrary. Okay, the next one here is Xmode. You know, Xmode's an interesting company because it's right at the intersection of data and privacy and geolocation data. So geolocation, another little tech buzzword bingo for you. All right, so this company is also about the same size as Cybrary. It's $9 million of subscription. It's growing 100% a year. Okay, the captive community in that business today it's basically 30 million daily users of apps that allow their location data to be shared. Okay, so you might have been reading the New York Times recently. Xmode was mentioned in it. Okay, it was highlighted in it. So I tell you, I think there's a massive opportunity in that industry for a leader to emerge and really set the tone on the right trade-offs and level between privacy versus the advantages of having location data shared. Okay, because the reality is we need location data at times. You know, figuring out how to do that in a economically accretive way for everybody is an interesting problem, and Xmode's working on that. So Xmode's a little smaller investment for us. Okay, it's only $3 million. You know, normally we like to start at least in the $5 to $10 million range, so that we're starting to build a portfolio. Okay, but there was only $3 million available in this one, and we think we're going to have chances to add more to it here this year, probably first half of this year. I don't know if Josh has arrived yet. Oh, there he is. Sorry. So Josh, yep. Okay, founder, CEO. And Josh has a really cool personal story, you know, if you want to catch up on that. So thanks for coming, man. We're totally fired up, and I completely telegraphed our willingness to invest more. So congratulations. All right. Okay. So now let's talk about some of the companies that we have that are, you know, SaaS companies, but we don't have all the plus yet. Okay, and look, and what I would tell you is we want to get the plus. If we can't get the plus, we'll end up with a SaaS return, which ought to be good. I just think the way to go from good to great in this instance is to get the plus. All right, so here's what we have in this zone. So one is Calaterra. Erin Nelson's around here. I saw her. There she is. She's the CEO of Calaterra. Look, Calaterra is an Austin, Texas company. Okay, it's about $11 million in sales. It's growing 10% a year. So part of the plus part here that we want to get is to accelerate that. Calaterra sells software to state and local governments. Okay, so right now they have 100 customers that are municipalities. One of them is the city of Austin, Texas. Okay, so for those of you in Austin, you're directly benefiting from the software. You're indirectly using it. Okay, inside of those communities that they serve are literally more than 50 million citizens, and I forget how many billions of payments are tangentially related to that. 5 billion. Okay. So from time to time, so this software basically, there's a portfolio. It's Freedom of Information Act requests, it's court scheduling, and then it's compliance and permitting. So a lot of real estate folks here in the room in Austin, Texas, if you're building something and you're trying to get that building permit gets processed by Calaterra. Okay, so it's not our fault it's going slowly. That's more of a city implementation thing. All right, but it gets processed by Calaterra. Okay, so today that gold bar, what that represents is there's a clear connection between new offers for that company for its B2B base. We do not have a clear strategy yet on how to tap into those consumers. From time to time, the company gets calls and says, look, you've got all this money flowing through you with this permitting. You should start capturing payments. Okay, so look, we may think about how to start capturing those payments and processing them ourselves. That's something that pops up. Okay, other things that pop up are just more offers around that stuff. Okay, so we'll see what's going to happen there. It's an interesting company. Erin's a heck of a good CEO. I hope you get a little time to interact with her. Okay, and the company gets regular interest, from other folks. There's a lot of consolidation going on inside of GovTech today. It's sort of one of these last bastions of SaaS is not fully permeated through that section yet. It's a ginormous, part of the software market. It just moves at a government pace. All right, so there are all the trade-offs on it. Okay, the next one is Fix. The CEO is James Novak. James is flying down from Toronto, Canada. Oh, sorry, there he is. Yep, sorry. I was looking for the glasses, dude. Okay, all right, so look, we're thrilled to be partnered with James. He's awesome, recently married, congratulations. Okay, and so let me tell you what Fix does. Fix is relevant for a lot of y'all's businesses, I think. It is a SaaS solution for critical maintenance and infrastructure. All right, so they do a lot of stuff in data centers. They do a lot of stuff in the oil field. That's where I think for our shareholder base, there's relevant application. And what it is a piece of software that helps you maintain machines. That machine could be a pump. That machine could be a chiller. That machine could be an HVAC. I mean, it could be a compressor. It could be all sorts of stuff. That's what their software does. Okay, so you can use it in your data centers, right? So I think that Fix, we invested in it a couple years ago. Look, it's growing at a high rate. It's 14 million in ARRs where it ended 2019. And look, it's underway. And I would say the growth rate and the momentum it has in its market category for SaaS, for critical infrastructure, is tremendous. I mean, it is a category leader, and it's kicking a lot of butt. And its embedded community inside that subscription base are thousands of technicians and literally millions of machines. So when you think about new offers for those machines and technicians, it's stuff like doing predictive analytics on that machine breaking or predicting it's going to break. And then in order to prevent such breakage, matching the part to that machine. Matching the part to the machine and the tech to the machine to make the machine gets fixed. Okay, but that takes a pretty robust tech stack, which is still under development. All right, so you can see how what Fix's opportunity is to increase its mission criticality inside of its customer base. And if it can add a programmatic match, it makes the subscription more valuable. It makes the outcomes better for the users. All right, so this is a good example of SaaS Plus. The next one here is Yonder. So Jonathan's going to be coming. Okay, Yonder's a super interesting company. Okay, it's an Austin, Texas-based company. It basically has a technology to detect manipulated messaging on the internet. Okay, so let me give you some examples of that. There are mathematical models around how ideas spread organically and naturally. All right, and when when you see ideas spread in an incongruent manner with those models, those are ideas that have been manipulated. Okay, and there's all sorts of economic incentive to manipulate messages. All right, so the company first discovered this with respect to the presidential election in the U.S. in 2016. The company got a lot of press about that stuff. Okay, so they have the government as a big customer, for these things. They also serve a number of brands. So if you're a big branded consumer company like Disney, and you're rolling out a new movie, how the internet masses influence your Rotten Tomato score really matters. Okay, and so being able to diagnose and detect when the masses are, up to nefarious activity with respect to your Rotten Tomato score is a valuable piece of data. Okay, so what Yonder has done so far is they're creating, a lot of their work is by project. They've also created subscriptions to where they are selling this into big brands so that big brands know when little factions online go to manipulate outcomes that cost them lots of money. Okay, so that's a super cool, a super cool project. The embedded community inside of those brands are basically the loyal fans on the internet. Okay, so when you think about the way a lot of this happens is there will be a handful of, for lack of a better word, nut jobs, right, that don't like a Marvel Avengers movie, and they're going to do everything they can to manipulate negative messages about Marvel's movies. Marvel also has plenty of fans online that can ostensibly go and counteract that, and so it's about mobilizing those people online. And for big brands, that's a really compelling thing. It's a really compelling thing. So that's the defensive move. Okay, there's also a potential offensive move of now you know how to mathematically spread messages in a manipulated fashion, which we haven't touched that yet. Okay, but so right now the mission and purpose of the company is really more on the defensive front. Okay, but it's a super interesting company. Jonathan Morgan is the founder. He's going to be here, so I encourage you to catch up with him. Okay, so that's the portfolio. So the investment thesis is we're going to take these SaaS plus companies, we're going to accelerate the growth, we're going to try to add some elements to give them an over-the-top chance with a programmatic match. Here's the investment team that's doing it, so we're just putting more names with faces, all right? So if you go back to our structure, we have an investment team. These folks are sourcing deals, executing deals, assessing deals, et cetera, all right? They also get involved in BuildGroup Ops. Okay, our BuildGroup Ops team right now, we've partnered with Barry Liebert. He's in the back. Just so you know, he always wears a black shirt. Okay, so he's easy to pick out. What Barry's helping us do is we are applying our MBM thinking and playbooks into these companies. Okay, so right now we're applying it in a meaningful way with Peter Wang. So if you want to get some data about how that goes, all you got to do is talk to Peter. Okay, we're also starting it with James at Fix. So he's off and rolling as well, so you can talk to James about it. Okay, and I think we're thrilled to be partnered with Barry. He's doing great work. At our next meeting a year from now, this meeting we're really focused on the investment strategy and making sure you understand, look, we're SaaS at our core. We're adding some of these other elements because software business models are changing, and we want to invest into that rising wave. Okay, we want you to, that's the main takeaway from today with what we're doing. Next year, we'll get into the playbooks. All right, next year we'll show you on a more tangible basis how we actually go about some of this stuff after we make the investments. And then the last team to talk about here is our data science team. Okay, they're busy away, working away right now in dark rooms with green codes. Okay, they're led by Ian Rickey. Ian worked with Gray, back in the day at Alert Logic. I'm super excited about this because look, we're using technology to make technology investments, right? I mean that's what's going on with our data science team. I think the software we're creating here, we started building it for ourselves, all right? And the notion there is, man, as we build this company that we all own together, 20 years from now, I want code to run a big chunk of it. So it's not all human driven, right? Let's be able to cover more ground, more efficiently, more cost effectively, make more rapid decisions based on the code really acting as a filter for the investment opportunities that we're doing. All right, so we've started this basically as you could call it a little skunk works inside. We've been writing the code. It's only, we closed 18 months ago. We've been writing the code, less than that. All right, we found a good asset over in Barcelona, Spain. That's where Xavi is from. We're incorporating that technology into what we're doing. The rest of the team is here in Austin, Texas. And so later this afternoon, we're going to share this. All right, so let me tell you about that. So our intent here is we built this software for us. We want to share it with you, our shareholders. What's going on in this software, when Jim does his demonstration a little bit later on, you're going to see how you're going to have transparency into every deal we're looking at. You'll be able to look as those deals progress through our pipeline and we assess them. You're going to see scoring models we use to assess those deals. You're going to see this battle between the machine and the human assessing it to see who wins. Okay, this is a very Darwinian, interesting, statistical thing. Okay, and coming out of that battle, the system's learning. All right, so our hope is that the way we engage with y'all is that if you want to know what's going on at BuildGroup, log into this and you can see. If you want to know how BuildGroup's thinking about investments, log into this and you can see how we're assessing them. And we're also going to invite you to, if you're so inclined, to put your deals in here too. Because the more deals that flow through it, okay, look, it's all confidential, it's all in a secured walled garden, okay, the smarter the system's going to get. Now, word in Austin, Texas got out that we were building this system. Okay, so there have been other members of the community that have showed up and said, hey man, we'd love to take a look at your system. Can we be part of that network? Some of those community members are our competitors, okay? Some of those community members are other entrepreneurs. People want to get a piece of this thing, based on early demand. So we're trying to figure out what to do with that. Okay, full disclosure, we don't exactly know. We had a very spirited board debate about that yesterday, okay? And so that was really valuable feedback. So what I would tell you now with great conviction is I think we're building really cool software that's going to make our company more valuable and more effective. Okay? What I don't know is if we can spin out that software in a way to make that more valuable and effective for the whole world too, and therefore make a bunch more money. I don't know yet. Right now, I kind of say that's free option. I think what we got for sure is software that's being developed for us in a compelling fashion, and you'll get the demo later on. And look, we're going to pitch the community. We'll see what they say. Look, y'all will be here. If the whole community is going nuts, maybe we got something. If not, we'll build it for us. It'll be our system of engagement with y'all. Okay. Oh man, that's what we're calling an open exchange. My bad. That was supposed to be up there when I was doing that cool pitch. So we called it open exchange. Okay. There you have, there's our branding, a few little animation points. Okay. So now I want to share with you some lessons from the past year. Man, I'm like running a little bit ahead. This is perfect. Okay. So here are the lessons from 2019, from a BuildGroup point of view. I would say, look, there's a lot of money flowing around. Look, we all know that S&P 500 is at record highs. I just told you Salesforce has a $160 billion market valuation on $13 billion of revenue. It's frothy out there, right? It's frothy out there. Now, because investment, I think, skews toward luck anyway versus skill, the way to overcome this stuff is to be super disciplined. All right, so we have a very disciplined process. We are just focused on these SaaS plus companies. We have a methodology to assess them. We have a playbook to implement ideas. That's what's going on. That's who we are. Okay, and we're going to stick with that discipline. Okay, so if you look, we've been closed 18 months. There's about a third of the capital that we've raised that's been invested. We feel good about those bets. We're working hard on them. But I think the pace we've demonstrated is probably the pace to expect. Okay, so in a flush world, we got to stay disciplined. And then relative to our competitive set, we've got to be differentiated. Right? I would think the core point of our differentiation is the fact that if you look at the senior executives of BuildGroup, they have an extensive entrepreneurial backgrounds. It's this operator heritage that makes us unique. I think when you look at our investment thesis and the strategy around SaaS Plus, developing into MBM, nobody else is pitching that out there that we've come across. And then the coup de grace is that we have a permanent structure. All right, so when we get into situations and when we're talking to companies, I feel like we check this amazing trifecta of boxes. Okay, it's wow, we've actually built companies before, so we have all the scar tissue. All right, we have an investment strategy and insight and playbooks that are going to help you build. And then on top of that, you get to build to your potential because we are a permanent vehicle. Now, that's very different than how funds work. When funds are investing in stuff, they don't talk about the permanent vehicle thing because they're not, because they really want to exit in just a handful of years. And that just creates a lot of pressure on companies to recycle shareholders. We lived through this at Rackspace. It's part of the reason we went public. Okay, every software company I know has different investors in there, and different investors have different timelines. And so being able to position ourselves as there's going to be a slug of capital that owns a 30-year company that's there for the distance is compelling. Okay? Now look, for all of us as owners, when it's the right time to exit, we're going to exit. Okay? But being able to pitch and position ourselves with the entrepreneur that, hey man, we're in it for as long as you want to be it, works, and it's the truth. Right? It's really cool to be able to sit and say a CEO, hey, we're in here for you to hit your potential. Because we're after-tax, long-term oriented investors, potential may take 8, 9, 10, 11, 12 years. Okay? Man, we want to compound that long. Better for us on an after-tax basis. There aren't other investors doing that. Okay? And when the CEO comes back and says, hey man, time to exit, turns out it's time to exit. Okay? That's what we're going to do. All right? So I think we have a really unique point of difference, in the marketplace. Things that we got to do going forward, the bigger our portfolio gets, we start to have constraints around BG Ops. Okay, we just got to invest and build that capability. And so the way to scale the company is we're going to have to scale it with data science first. This gets back to having code do a lot of the work instead of humans. And then a lot of our power and point of difference is BG Ops. So being able to provide the cycles there in a repeatable system, for entrepreneurs is critical. That's critical to what we're doing. Okay, and then I'd also say, right now we're in a situation where our individual brands are more powerful than the BuildGroup brand, right? Just because BuildGroup's only been around 18 months. So we got to go to work on that too. We want to be in a spot where, when you walk down the street and say you work for BuildGroup, or, like Jim's got his BuildGroup backpack, whatever it is, you're like, dude, I want the backpack. Okay, we're not there yet. All right, right now our individual brands are bigger. Okay, so we got to do some brand building. We're starting that this afternoon by inviting the community in, okay, to rub shoulders with you. Because look, you're part of our pitch. It's pretty cool to say, we're not a fund, we're an LLC. And our shareholders are all successful entrepreneurs that went on 15-year journeys to crush it. All that is very congruent. It's kind of perfect alignment with our mission and what we're trying to do. All right, so over the next year, we're going to build the brand more. And then the last thing I tell you, I think the PE downside, VC upside is achievable. I think with this strategy properly executed, we just might have our cake and eat it too. Okay, not on every one. All right, some will just end up with regular old SaaS returns. Okay, but the ones we can truly activate, I think we'll have a little cake and eat it too, a little bit of PE downside and VC upside. Okay? Look, so we've got like 7 minutes. You know? What would you, I was supposed to save you 20, so I got a little, rambunctious. But we got 7. Anybody want to launch a Scud? What do you want to know? Or was I perfect? I will take perfect, no problem. Okay, that's it? Yeah, well, every now and then, Mamacita. Okay, Don Roberto McLean. Okay, fire away.
Talk about pipeline. Maybe that's going to come next. Just talk about what you're seeing out there. You talk about valuation from.
Yeah. Okay, yeah. So, no, great question. Okay, so Rob's question, so we're going to hear it, is talk about what's next. Talk about the pipeline. So when you say pipeline, I think, what deals are you about to do? Okay, all right, yep, so that's a good question. So yesterday, it turns out we talked about that in the board meeting. There's 5 or 6 opportunities, okay? Look, we're all under NDA, so I'll tell you. So what I would tell you is, we have confidentiality obligations to all these companies, so just don't tell anybody outside of this room. Okay, that'd be a breach. All right, but I'll tell you the 5 or 6 things that are on our radar right now. Right now, there's another company up in New York, so the VidMob guys are in New York. This is a big, ad tech company. I think it's $90 million in sales. It's growing 60% a year. It's profitable. That's interesting. Okay, now that company, so the deal with this one is the company is a great company, but it's in a bad neighborhood. Ad tech's a bad category, and I'm used to being in bad neighborhoods. Okay, it turns out that Rackspace was hosting was a bad neighborhood for a decade. All right, so that to me kind of thinks, this is how you get things at a better price. Okay, but it's still a bad neighborhood, so we're sorting that through. Right, that is an investment decision we're going to make next week. I don't know how many pages of analysis we've done on this thing. It's a bunch. Okay, so that's an investment decision next week. There's a company out of Utah that Bud and I connected with. Okay, what this company does, it's really cool. So when everybody in here makes investment and does deals, basically what this company does is you take your deal doc, you send it to them, they scan it, run it through their technology, and they give you back a summary of what you actually bought. And it turns out what you think you bought, what you actually bought, are different an amazing amount of the time. An amazing amount of the time. Okay? And so right now they're selling that on a monthly subscription to venture capital firms. It's a couple $100 per month per company. Okay? And so these guys have extended the round. Noble, I did a great piece of selling on this guy. Okay, so look, I really like him. He's a corporate security lawyer by training. He's hung his shingle out. He started his own company. He's raising $7 million bucks now. There's another big investor that's going to come in that I think is super value added. So that's another decision here that one's more like the next 2 or 3 weeks. Okay, so that one I'm excited about. There's a local company here in town. Okay, what this company does. How many of y'all use Slack for instant messaging? Yeah, a few of you. Yeah, okay, all the geeks in the room. Yeah, okay. All right, so Slack is, for those of you that are still in the email universe, okay, it turns out there's this thing called Slack, which is basically, instant messaging in the workplace. So Slack has, I would say Slack has a big market share with nerdy people or startups. There's a competing product out of Microsoft called Teams. Microsoft is doing what it normally does, which is, hey, I got a competing product. It's not as good, but you can have it for free. Okay, this is what they do. Okay, so they've launched their Teams product. So Slack is publicly traded as a multi-billion-dollar market cap. And what the challenge is, if you have one part of your company on Slack, this is where your developers and geeks and growth-oriented people hang out, and another part of your company on Microsoft, they cannot message each other. Okay, so what these guys did is they created a piece of software that's basically connective tissue between these two camps, right? Then the next interesting thing about it is, how can you speak not just within your company across those platforms, but into your suppliers, into your lawyers, into your customers, right? So they're building out that as well. Okay, so it's an interesting company. The number one risk factor on that to me is, if Microsoft kills Slack, you really don't need interoperability because it's a 2-horse race. There are 4 or 5 other horses out there. Cisco WebEx has a horse, Yammer has, there's other competing products, but really it's kind of Slack and Microsoft at this point. So what the company's doing to enable communication is interesting when you think about creating sort of a modern approach to intercompany communication. I don't know how much time y'all actually spend on the phone anymore, right? But the generations behind us really don't. Okay, so I think the notion of messaging across companies and across supply chains is a real deal. So that's interesting, but I worry a lot about Microsoft just killing Slack. Okay, so that's another one that we're sorting out. Okay, I think there will be incremental investment opportunities in some of the portfolio companies here coming up. I talked about X-Mode, as one of them. I think Yonder, which is the diagnosis detection, okay, is another one. There are a few more, but I can't remember off the top of my head. There are like 6 that we got to make in the next, month or 2. So I think I gave you 4 of them. So I'm missing a couple. Yeah. Okay. Yeah. Hey, Steve. Yeah. Good morning. Hey. The burn rate or cash flow of BuildGroup as a whole. Okay, yeah. So that's an interesting question. Okay, so the way our economics work at the moment, okay, is basically, so the number one investment amount, expenditure, whatever category you want to put it in for BuildGroup is people. Okay, it's people. So it's the people in this room, and it's basically the people in this room. I think everybody's pretty much here. Okay, that's our number one expense. The number 2 expense is rent. So the way it basically works is every year we're drawing down some capital and fees from the shareholders. We take those fees to run BuildGroup. Okay, over time those fees expire. We also call capital to make investments in these companies. And when we sell a company, the money's coming back to us. So our burn rate today is about 2% of that total capital base. Okay, there are opportunities, that we were talking about. There's another really big opportunity that we were talking about yesterday. They may have an opportunity to do some structure around it to offset some of that, but I think that's very low probability today. So I think the way we will operate for the foreseeable future is like the way we've been doing it. Now, the only thing I nuance that a little bit is because we're 18 months in, we had some one-time stuff, move into the office for the first, all that kind of stuff. But I think by the end of this year, we should be through that. That should be in the rearview mirror. Oh, sorry, my bad. Okay, yeah, that was a very cool answer, though. Okay, yeah, so okay, so across the companies, so the answer is it varies. Okay, some like Calitaire is profitable. Okay, others are break even-ish. Others are burning. Okay, so the way our fundamental unit of analysis here is the individual unit economics for the company. So let's talk about what we mean by that. Okay, part of that is basically when you look at the core margin of a product. Okay, so we have a software subscription. What is the core margin on that subscription? And then you start to look at customer acquisition economics, right? How much did it cost to buy a new customer? Apply it against that margin. So what's the lifetime value of that customer? What's the upgrade rate, et cetera? So in everything we do, we more than obsess about that core engine. Okay, so if you go back to the Rackspace days, we had a great core engine, but burned money for a long time. So our take on it is we want to get to the point where we understand those unit economics. With those unit economics, we can decide how much to throttle the growth, right? So from a philosophical point of view, understanding that, the throttle the growth part really comes down to what experiments can we run. We prefer little bets over big bets. Okay, so I'd rather have a portfolio of little bets. As those little bets start to mature, the ones that work, let's do more of that. The ones that don't work, let's kill it and figure out another bet. Okay, so that's our perspective. Because when we're, looking at these companies, look, the great news about SaaS businesses in general is they should have really good core, like this sort of, whether you want to call it gross margin or contribution margin, man, that ought to be 70+%. Okay, so anytime you have a recurring revenue, 70% contribution margin thing in your core, you can do a lot of experiments, right? You can do a lot. So that's where we are, because if you look at companies like Cyber is a $9 million AOR business growing 100%. It has an amazing cost of goods advantage based on its community that's delivering some of the content. Look, the company also creates content too. Then it has really compelling unit economics on that subscription base. So some of the experiments start to be, well, okay, what other content should we create to drive the subscription? How do we put more people into the community? How do we grow faster? What sort of go-to-market stuff, programs do we do? So we're still, I would say, somewhat in the growth laboratory mode from experimentation across these companies. So when we're in this experimentation mode, I would say the contribution margins will stay pretty similar over time, but the net income margin over time will be very different once it hits a more steady state. That's how we think about it.